All right, Jitendra Gohil is here with us. Jitendra, afternoon. Thank you so much for your time. Jitendra, what are you making on the market valuations right now? Global liquidity. But in the last, at least today, we are seeing that yields have started rising once again. We are also just starting off the earnings season. How are you putting all these pieces into perspective?
Yeah, hi Ajay. Thank you for having me on your show. So first of all, want to reiterate one thing is that Credit Suisse has been guiding investors that market is actually underestimating the economic recovery, and now I think it is nicely playing out. We have seen tax collections have started improving. Even today morning, we have seen a couple of credit rating agencies have upgraded India's GDP forecast, and fiscal situation is much better than feared. And this is what our central scenario was, and hence we have been for the past 1 year have been a little more bullish than the market in terms of India's valuation. Now the key question is, since valuation is already re-rated, in fact we are trading at more than 85% PE premium versus MSCI emerging market versus average of 42%. So already the price to earning ratios have re-rated materially. Now the question is whether this is a peak and whether we will see some kind of selling, because India's valuation has risen to a kind of one of the highest levels in the last decade or so. So I feel that valuation will remain elevated. However, we do not rule out a 5 to 10% kind of a correction. That is pretty normal. But we think that the valuation for India is going to remain elevated relative to peers, and on an absolute basis also compared to our historical standards, we think that the valuation will remain elevated. There are a couple of reasons why we believe so. We think that the India's structural appeal has improved materially. You look at exports, you look at FDI, you look at corporate balance sheets, or you look at banking balance sheets. Who thought that when we contracted by 7.5% last year in terms of GDP, our NPA ratios in the overall banking system has gone down. The leverage has gone down. So I think structurally India is in a much better position, and India in a sweet spot looking at the geopolitics. So I feel that valuation is little stretch and it's little concerning, but in my view, it is going to remain elevated relative to peers for next few quarters or so. Now, coming to your point, yields have started moving higher in US. Yes, we touched almost 1.2% in 10-year yield a few months ago, and now we are closer to 1.45, 1.5%, and I think that can lead to some kind of correction in terms of valuation. So I don't rule out a kind of a small correction across the emerging market equities, including India, in the near term. But from a medium to longer term perspective, we think that one should look at India from a positive lens, looking at the reforms, looking at the earnings trajectory that we are expecting over the next couple of years. We think that any correction in the market should be a buying opportunity.
Jitendra, I must congratulate you on your call much ahead of everybody else, and the people who would have heard this discussion before a couple of months back too may have participated well. From here on, what are your thoughts on the quality of earnings going forward? We have been almost 4 quarters into a good earnings quality kind of a phase. Does this time it appears that it can go beyond 4 to 8 quarters, or do you think earnings could get challenged, or you think the economic activity will be so robust along with global growth, strong global growth, that it could be more durable? What are your thoughts there? Because one side of the people believe that inflation is setting in and it will eat into earnings.
I think it's earnings is going to be a mixed outlook. So I am not extremely bullish on earnings as of now. I feel that it is better to remain little conservative on earnings. In the near term, for example, next quarter, upcoming quarter, I feel that there could be some kind of disappointments in terms of margins. However, the outlook commentary will be positive. So it remains to be seen overall EPS impact. But I feel that it's a sectoral call. So for example, we are little bit more positive on earnings for financials, and which is large part of Nifty. However, we think that some of the companies which cannot pass on, for example, small and mid cap companies, globally exposed companies, globally cyclical names, including chemicals, I feel that may see some kind of a margin disappointments and earnings cut. While on the other hand, we expect that banking sector can compensate for that. Even energy sector, linked to oil, they are able to pass on commodity cost pressures. Cement companies, may see margin pressure, but looking at the kind of pricing power they have, so overall EBITDA per ton might be lower than last quarter, but still they will be able to pass on. So it's kind of a mixed outlook, and hence what we are recommending our investors is that move from small caps and mid caps to large and mega caps, because we feel that they are the best positioned companies to pass on raw material cost inflation to the final consumers. However, if you look at overall broader asset allocation call, we are not going to look at quarter on quarter earnings, but we are going to look at 2023 earnings, where we think that we look pretty strong, because our view is that market is still underestimating GDP expectations for India over the next couple of years, and we may see some kind of earnings upgrades driven by faster than expected GDP growth in the next couple of years. So from a medium-term perspective, we remain extremely constructive on EPS trajectory for Nifty and other companies. Remember that before COVID, we have already seen, we have cleaned up our balance sheets, corporate balance sheet. We have cleaned up, the banking balance sheet. So the base is lower from that perspective. So I feel that India is going to see a multi-year kind of a earnings, strength in the next couple of years. However, extremely near term, next quarter or so, I think that inflation is going to eat up in margins, and hence we are focusing more of mega cap or large cap companies as of now from a near term perspective.
How are you playing the export theme? I mean, lately, anybody we speak to, any sector, is talking textile, garments, machinery, capital goods, chemicals. It's talking about buoyant demand from the export side. How are you guys analyzing the export opportunity?
So I think Ajay, you first covered me in terms of chemicals and urbanization and companies. We identified few structural themes. So we remain structurally positive on certain sectors which are gaining market share in export domain. For example, there are certain chemical companies who have been actually coming out very openly and increasing their capex, looking at next 5-year growth trajectory. So from a structural perspective, definitely we feel that whatever reforms that government has taken, not just in ease of doing business, but also in terms of infrastructure, in terms of backward integration, in terms of PLI schemes. So these are the themes which are emerging, and I feel that this is a sector which may see higher than nominal GDP of India. So some of the sectors in API industries, for example, in pharma, we are extremely positive on API space. Chemical, we continue to be extremely positive. Some of the manufacturing companies are now setting up export, are trying to exploit export opportunities. So I feel that export is going to see some kind of a strong revival over the next few years, and it is a structural theme for India. Looking at past so many years where export remained stagnant, we are turning little bit more constructive in the sectors which are looking at import substitution and also export promotion. So I feel that that sector is looking pretty strong for us.
Right. All right, Jitendra, we'll let you go on that one. Thanks so much for sharing your inputs and the way you are analyzing the investing environment. With that, it's a wrap on the show. Thanks very much for watching. Goodbye.